Morning, everybody. Happy New Year. It is 2022. This is the first webinar of 2022. Good to see everybody. You are just piling in right now, so I'm going to say it again. Good morning. Happy New Year. I hope everybody had some nice downtime over the holidays. We had a trip that was supposed to be, we were supposed to go to visit David McKnight in Puerto Rico first week of January, and that got changed to Austin because of COVID, and then we all got sick, so everybody ended up staying home. So I hope that didn't happen to you, but it seems to be a trend. So I hope you're all feeling well. I hope your families are doing well. So let's get right into it. It's the year starting out very interesting as we anticipate it, but there's a lot of conversation out there around inflation and interest rate hikes, and we're going to talk about that a bit today, and the Fed and what the Fed can do regarding interest rates. There may be some challenges for the Fed coming up over the next few years. We're going to go over our slot reports for the first 15 minutes or so. A lot of updates about required minimum distributions. And we're going to talk about the markets, how the markets did last year, and what I think is going to happen this year, and where we are so far this year in the few trading days we've had. We're down about 200 points so far today, but a lot of uncertainty around the Fed chairman's testimony or statements that everyone's expecting. So just remember that we are recording. You are on mute. You should have a Q&A function on the bottom of your screen, and but chat should be disabled for you. If you want to, if you're watching this as a recording on YouTube or on the website, and you want to schedule an appointment with me, you can do that with the link. If you just want to go to a certain topic, it should be indexed on the YouTube video or the platform. Wherever you're watching this, and you should be able to jump right to, let's say, for example, if you just want to go to the discussion about the raising interest rates or the financial planning topic of the day, you can go right to this. If you're watching this via recording, if you're live, you're just going to have to sit through it. I apologize for that. And if you're live and you want to schedule time with me, the calendar should populate after this. And then you can do that. If you're a client and you're already scheduled time, please keep your existing appointment. Unless you need something right away, then just give us a call and we'll take care of everything. I'll give you a little update on our practice in the building. We're still in construction mode. Contractors, I think, are probably the most optimistic people out there. We were told time and time again, middle of January, but it's just not going to happen. So we're looking at the beginning of February. We're really, really close. I stop in there just about every day to see what's going on, and we're really, really getting very close, but still a few weeks away. So we have lots coming up for you. Next Wednesday, we have David McKnight joining us from January 19th. So that's a Wednesday special webinar from 6:30 to 7:30. You will get an invitation. I assume tomorrow you'll get that via email, and then David McKnight Live will be here April 27th. And we've got a lot of great special webinars planned for the first half of the year, some live classes. So busy year already for all the things we're bringing you from out of our wealth management. So we're going to talk today for financial planning. Really what we're hearing from the Fed, that they're going to raise interest rates 3 times this year. I'm going to discuss it. Some folks are saying, well, it really could be 4. And what does that mean? And can the Fed really raise rates? We're going to talk about what that means. I think that they may have a hard time pushing a rate raise at 3 or 4. They're going to really have to be soft on the pedal as far as how they manage that. So let's jump into the Ed Slott updates, and it's all about RMDs in these updates. So there's a big change this year, and I'm just going to share with you. And hopefully by the end of the day, you'll be able to access these charts. Oh, goodness. So I don't know where my chart went, but there's a new required minimum distribution chart, updated life expectancy chart that you must use now for required minimum distributions. So you're going to be able to download that from my website. It was, we uploaded the new chart, but it's a little off center. So I'm getting that fixed. So I'm hoping by the end of the day today, but certainly by the end of the week, you're going to be able to update or download that new chart. If you can't wait, just send me an email and I can send you over the chart. But you've got to use the new life expectancy charts. These were based on life expectancies pre-pandemic. So I don't know if they're going to make adjustments. Life expectancy levels have come down a little bit, but you have to use the new charts. So there's a lot of discussion about these new charts, and of course RMDs. RMDs are always a confusing topic for many. And let's just jump into our first letter is from Ian Berger. You've heard from, Ian Berger. You've heard from Ian before. And Ian writes, welcome to 2022. One of the big changes in the retirement account world this year will be the calculation of required minimum distributions, as we talked about. There are 3 tables. One is the uniform lifetime table. That's what you use for your own RMDs. And that's what's used in most cases. Then you have the joint life expectancy table used instead of the uniform lifetime table when a spouse is the sole IRA or plan beneficiary and is more than 10 years younger than the IRA owner or plan participant. So a few of you may use that. So your spouse is more than 10 years younger. Then you have the single life expectancy table. This is used to calculate post-death. So in certain circumstances, beneficiaries can still use this single life expectancy table to do the stretch IRA, if you remember. And these are for designated beneficiaries of IRA owners who died before 2020 or who are eligible designated beneficiaries. So if you've been taking your required minimum distribution based on the old tables, you have to use the new tables. The IRS has issued a new set of tables effective for 2022 RMDs. The new tables reflect the pre-pandemic, I've talked about that, life expectancies. So they should result in smaller required minimum distributions because prior to the pandemic, our life expectancies were longer. For 2022 lifetime RMDs, the new uniform lifetime table and joint life expectancy table will be used without any adjustment to account for the fact that pre-2022 RMDs were calculated using the old tables. This is where it gets a little tricky. However, beneficiaries other than spouses who inherited before January 1st, 2022 and are using the single life expectancy table will be required to reset their 2022 RMD. So they have to go back and do a reset. So using a single life expectancy table, if you're doing this yourself, there may be a problem with your calculation because it's very common. What you have to do is you have to determine what age you were when you inherited the assets and you started that factor. Say your factor is, just to make it simple, 14. Now, with required minimum distributions, normal required minimum distributions, you go to the table every year, right? If you're taking your own distributions using the uniform lifetime table, you have age 72, age 73, age 74, that gives you the factor. With inherited IRAs using a single lifetime expectancy table, you start at 14, for example, not age 14, but let's just say age 72 at 14. That's not the number. I'm giving you an example. And then you subtract it every year. So your next year isn't going to be, 13.2, for example, if that's the next number, it's 13, right? You subtract 1 from where you started. This is where people get in trouble with inherited IRAs and RMDs because they think they go to the table every year and they don't. They have to do that subtraction. So what the IRS rules are telling you is, so now if you've been using that and you've been doing it correctly, you have to reset. You have to go back to the beginning. So with the new table, you have to find the age you inherited the money and then count back and get a reset on it. So I know that's confusing, but listen, all the rules are confusing. For 2022 RMDs, beneficiaries do not use a single lifetime expectancy based on their age in 2022. Instead, he's explaining everything I told you. So here's the first question we have in the slot report. So again, this is from Ian. Has the IRS clarified the 10-year rule on inherited IRAs? Remember that changed. It used to be for non-designated beneficiaries, eligible designated beneficiaries. If you set up a beneficiary designated IRA, and this is prior to 2020, yes, I believe so. Then you could stretch the IRAs. If not, you have to distribute everything within 10 years. There was some confusion in the middle of the year last year because the IRS came out with a notice that said that you had to take required minimum distributions also during those 10 years. But then they corrected themselves. They acknowledged their mistake, and they have clarified that yes, you can wait until the end of that 10-year period. So the question: has the IRS clarified the 10-year rule on inherited IRAs? Do you have to take RMDs each year, or can you wait until the 10th year? Also, does this rule apply to inherited Roth IRAs? We're all big Roth fans here. Does it apply to Roth IRAs? And that's from Daniel. And the answer is yes, Daniel. The IRS has clarified that the annual RMDs, as I just told you all, from the inherited IRA are not required under the 10-year payout rule. The 10-year rule only requires that the entire account be distributed by December 31st of the year of the 10th anniversary of the original IRA owner's death. Remember, we kind of walked through that at the end of the year last year. But what if you inherit from your dad, and the dad's money goes to mom, and then that might be, and then so yeah, mom could keep it as an inherited IRA, and then you're a beneficiary of that. You've got to use dad's, the original IRA owner's death, as your calculation point for the 10-year anniversary. The rule does also apply to Roth IRAs. So yes, Roth IRAs also have to be distributed by the end of that 10th year of the original IRA owner's death. Not unlike, we've always been required for an inherited Roth IRA to take required minimum distributions. Always had that requirement. You, as a Roth IRA owner, do not have to take required minimum distributions, but your beneficiaries do. They want that money back in the taxable circulation. Now, if you're a spouse, of course, you don't have to take, there are some eligible designated beneficiaries, and the most prominent one that we see all the time is a spouse. So here's another question. My wife inherited an IRA from her mother. I understood she had to take out yearly distributions. We have calculated these distributions. You might want to write this down. We have calculated these distributions by taking single life expectancy table for her age when her mother died in 2015. So far, so good. So they went and they went to the single life expectancy table for her age when the mother died in 2015. My wife was 73 then. So the divisor, the factor number that is used to figure out how much has to be distributed, was 14.8. We've been subtracting 1 from that number each year since then. Last year was 8.8, and this year 7.8. So they've been subtracting it now for several years. Do I understand that now she may use the new this is a little odd the way they wrote this, but do I understand now that she may use the new 2022 life expectancy tables for her distribution for this inherited account? Well, you know now that it's not a may, she must, right? She must use that new table. She'll be, the wife will be 80 this year, and the divisor for her age 80 is 20.02. So obviously that's a benefit for them if 20.2, excuse me, not 20.02. If 20.2 is a larger number and they're at 7.8, a larger number is going to give you a smaller required minimum distribution. So that's going to work out with them under the new table. Well, here's the answer. That's Bill. It appears that your wife started taking RMDs from the inherited IRA in 2015 at age 73. However, her first RMD wasn't required until 2016. Too bad, right? So she took the first RMD a little early. The year after her mother died, the 2016 RMD should have been based on 14.1. This is where, again, so they started at, I think, 14.8. You can see how this can compound over time, and suddenly you have not taken enough money. In this case, I think, if I remember right, they've ended up taking too much. But life expectancy factor, yeah, because they started with a smaller number, 14.1, where they were working off of 14.8. Let's see, does that work? Well, let's see. Subtracting 1 from 14.1 each year after 2016 would mean that the 2021 factor was actually 9.1. It's not a problem if prior distributions were higher than the required minimum distribution. So that was right in my brain. based on your math, it appears the wife had taken a little more annually than she needed to. So that's okay. She can take more. She can take the entire thing if she wanted to. The problem comes in when you take too little, and just those small little numbers can add up over time. And then you have to catch up, and you have to file the paperwork for every year you've missed that required minimum distribution amount. And can you tell me what the penalty is for missing a required minimum distribution? And that is, yes, 50%, 50% of what should have been taken out. So that could be really expensive, especially when you're talking about 7 or 8 years. So the moral of the story here is, use your team, use your CPA, use your qualified certified financial planner. You've heard me talk about the Slott Group and all the information and support we get from the Slott Group. We make sure that we do these things right. You don't want to get caught up in this. Many people believe that they can do these things on their own, Roth conversions, RMDs, and there are just too many landmines out there that you can get caught up on. Okay, so moving off of the Slott information or Slott Group, let's just see if there's any questions there. I see no questions. We got a full house today. Good to see everybody. If you remember, we're going to talk about inflation, and a lot of the discussion around the markets today are based on concerns over inflation. If you remember the November number that came in, year-over-year number that came in was 6.8%. 6.8% year over year. So now prices dropped in 2020, because of the pandemic. They started to climb back up towards the end of the year. So we're getting a little bit of balance, but 6.8% that's going to blow up almost everybody's financial plan. So that's concerning. So we're going to talk about the Fed later on, and you're going to hear Fed comments. The Federal Reserve, when I say the Fed, I'm talking about the Federal Reserve, and there's some governing tools that the Fed has to help produce growth, right? Economic growth, or help limit economic growth. And one of those is interest rates, right? And so they're really set to guide growth, economic growth, and to help stave off inflation. So inflation has come out really quickly and really aggressively. We all saw it coming. We started talking about it back in 2020, and we knew that it was going to come. Many people think the Fed is kind of late to the game, but there could be a really good reason for that, and we're going to talk about that. The producer price index that came out in November, I want to remind you, so that's how much it's costing to make things, is 9.6%. And we're all seeing it. We did. I did some barbecue over the break, and I'm paying a lot more for the big pieces of meat I get from Costco and the butcher than I did last year. So we're all seeing it. So we're going to talk about that. But let me give you a snapshot of where the markets were at the end of the year 2021. So just a few weeks ago. Well, I told you in the beginning of the year that it's going to be a rocky year, and it was. We saw a lot of volatility, especially towards the end of the year, but we still ended the S&P 500 positive 28.68%. The Dow Jones Industrial Average, so these are the big indices, and it's probably time for me to go and have another discussion with you all about what these things are and what they mean. We have a lot of new people. So I'm going to write that down, write myself a note for next or upcoming webinar to talk about what the heck are these indexes or indices that we talk about. Okay, I just broke my pencil. All right, so the S&P 500 up 28.68%, the Dow Jones Industrial Average. So these are the largest of the U.S. Stock indices. So it's a representation of how the markets or the stock markets are doing in the U.S. 20.95%, so almost 21%. So 28%, 21%. The NASDAQ is 22%. Really, really strong growth. That bonds were down slightly, right? So it could be as low as we're at 4.71 for the Barclays global bonds. So if you remember, this is where a lot of my concern sits, is in bonds, because if you think that you're offsetting the risk of stocks with bonds, you could be in for a wild ride. And if you have $1 million in your bonds and you're down 4%, do the math. Well, that's $40,000, and you might not like that. There's that may be comfortable for you, it may be uncomfortable for you, but many people think that bonds are going to be a safe place. But you've got to You've got to be very careful about the bonds you're choosing, how you're investing in those bonds, and they can be very, very volatile. So the 10-year Treasury was down. The 10-year U.S. Treasury was down 3.68%. So if you invested in the U.S. Treasury in the beginning of the year, 10-year Treasury, you've lost 3.68%. So that's not telling you to stay away from those things. It's just, let's be aware of them. So that was the end of the year, 2021. How about so far this year? So far this year, the Dow Jones Industrial Average is down 0.25%. So that was as of the end of last week. That was the first trading week of the year. The S&P 500 was down 1.83. It's down more today. The NASDAQ was down 4.5%. That's a big drop first week of the year. How about bonds? If stocks are down, we expect bonds to be up, right? Well, no. The Barclays Aggregate Bond Index, which is probably the most common that we see out there that people are investing in, was also down 1.53. The 1 to 3 year bond was down slightly, 0.27. I don't have the global on this chart, but I believe my memory tells me that was down. So I'm seeing all the bond indices, all the stock indices down, all the bond indices down. And you might say, well, how does that work? I've been taught that when one zigs, the other zags, but it's not always like that. So that's a challenge that you have with your investment management going into 2022. Let's hear what some of these analysts are saying. I added the Wall Street Journal to this week's discussion, and I may add them going forward. But there's a discussion about going back to normal from Jason Zweig, and he's pretty good. He's really mixed up in his article. He's referring to this year as 2021, so he needs a little bit more coffee there. But he points out that the S&P 500 has doubled over the past 3 years. So over 100% gains over the past 3 years. That's really, really great. So if you invested $1 million in just the S&P 500 3 years ago, the beginning of 2019, it's worth $2 million. Well, that's really great. So for those of us who stayed invested, right, you've got your investment process, you've got your allocations, you have your account segmentation, you have your principal protection, all the things that we always talk about. When you stayed invested, you've done quite well. You probably haven't doubled over that period of time, because most people aren't just investing in the S&P 500 for good reason. Because what happens typically when we have a lot of growth over a period of time? Well, the last time this happened, the last time the U.S. stocks doubled in only 3 years, Jason writes, was from 1997 to 1999. Well, what happened right after that? The S&P 500 fell roughly 40%. So now that $1 million that you've gained, now you've got $2 million, and that drops 40%. That's an $800,000 loss. So you're still ahead, right? But it may not feel that way to you. So I thought that was interesting, and I appreciate Jason. A little bit, I just have a headline from BlackRock: virus spike to delay, not derail restart. We're seeing another variant of this virus. It seems to be affecting more people, but we all know it doesn't seem to be as as difficult. However, we've lost some people close to us at this practice, clients, family, and you cannot, I hear this, but you can't dismiss it. Jamie Dimon, the head of this is from CNBC, the head of Citigroup, or JP Morgan, excuse me. So Jamie Dimon is the head of JP Morgan. Now he said, here's his quote: "We're going to have the best growth we've ever had this year." He's talking about his bank. I think since maybe sometime after the Great Depression. He believes that the Fed might, and he said next year will be pretty good too. He's talking about 2023. Consumer balance sheets have never been in better shape. So it's possible that inflation is worse than they think. They're talking about the Fed, and the Fed may raise rates more than people think. I personally would be surprised if it's just 4 increases. So Jamie Dimon's saying it's going to be more, and he usually has some pretty good insights. So that's let's see where else. Riverfront is very casual, like they've been lately. They say, let the Fed do the worrying. We're not concerned by the rate hikes in response to strong growth. So they're, you know, inflation is one thing, strong economic growth is another. The release of the Federal Reserve's December meeting minutes created a stir across financial markets. They're right. The minutes portrayed by a Fed that is increasingly worried about inflation and likely to move away from their easy monetary policies more quickly than many have thought. Investors who had been expecting a more measured approach were clearly surprised by the news. I don't think many people were surprised. I think that people were surprised that it seems to be very aggressive, where it had been more passive, and I think people were kind of just waiting for that to finally, you know, finally step up to the plate, guys, and there are people, and take some swing. We are less concerned by the release and believe that a sell-off related to Fed tightening fears may represent an eventual buying opportunity, perhaps. In this strategic view, Doug, this is one of the analysts, so he shares some key takeaways. The Fed is starting to discuss interest rate hikes. Listen, if this is all you follow, then maybe this is the first time you're hearing about it, or in a couple of weeks, as I talked about it in December. But most of you pay attention elsewhere, so you know the Fed's talking about interest rate hikes. This usually causes some uncertainty and volatility in our view. We think stocks can tolerate rate hikes if done in response to strong growth. They're hedging that, right? Because they don't want to come back and say, well, because someone will say, well, listen, we have all of our money invested with Riverfront. You said that stocks were going to be strong, and then what if stocks were down or flat for the year? They could come back and say, well, we're talking about strong economic growth. I really respect these folks. They do a great job, Riverfront. I don't invest my clients' money with them because they just don't meet the parameters. But their analytical team, I think, is very, very strong, gives us good insights. So they're the markets, folks. Let's just see if we have any questions. And I'll share with you, since I'm reading other analyst reports, but what we think is going to happen in the markets. I think it's going to be very flat in 2022, or slightly down, or perhaps even significantly down. So am I saying that we should pull everything out of investments and put it in cash? Absolutely not. Because look at 2020 as an example. No one thought that we were going to end the year positive in 2020, and it was one of the best recoveries we've ever had, if not the best recovery we've ever had. So if you would have sidelined your money in the middle of the year 2020, you would have missed a lot of great opportunity. And we don't want to miss opportunity. We want to make sure that we're covering our needs and protecting what we need to protect, and we have to use it in a planning landscape, not a reactionary investment. I want to get the most I can out of my money kind of landscape, because most people are going into retirement and they need those funds to draw off of. Now, listen, if you have a significant pension, you know, there are people with loads of rental properties and you don't need that money and you're just growing this portfolio, it's a different story. But that is not the most of you folks who we work with. Most of you folks have, you know, what I'll call a significant amount of savings, you know, several $1 million. And this is it. And that has to last your lifetime. And most of you think that I want to leave something to my heirs, but I want to make sure that I'm taken care of. Now, some of you have very specific estate goals, and I think that's great. But the majority of the folks, you know, they just want to make sure that their needs are taken care of, and whatever passes as most efficiently as possible from a time and a tax point of view. So it really comes down to making sure you've got your buckets of money set up. And there's a couple different sources of these buckets, and that's taxable, tax deferred, and tax free. We want to get everything we can in the tax free. You know, as you've got your mathematically ideal amounts, but you want to get everything else, remember, in the tax free. And we're going to talk about that. And just these reminders as we talk, you know, throughout the planning process. And I've got these classes coming up. You know, if you're watching these webinars, you can always attend these classes. And then you've got your planning buckets, right? Or what I call account segmentation, right? And there are the three pillars. You've got your asset allocation. You want to make sure you've got your funds balanced around the globe and in different sectors and with the appropriate managers and all that. And then you want a portion of it for most people in some kind of principal protected whether it's a CD or a fixed index annuity or something like that, right? Something that's safe and productive, we use the term. And then you want to make sure, in addition to that, so these things all work together. That account segmentation, make sure you have your funds for the next several years while all this craziness is going on with the Fed, and now we're gonna adjust out, because we all know we don't know what's going to happen this year, but we're very confident that in 5, 6, 7 years we're going to have positive growth in the markets, right? The next 3 years might be crazy, might be negative. Who the heck knows, right? The worst time that I've seen in my career has been 2007 to 2009. So that was a year and a half of nothing but down, down, down. And then it took a while to get out of that to where you were back to normal. So we want to avoid that. We want to make sure we have our spending dollars conservatively invested and that they're going to be available for us. And you go out the timeline. So I'm not going to go into every detail about that, but this has to be very, very calculated. And of course, it has to be reviewed and updated when? Well, every single year. Well, I've got a question here. Does waiting until, Gerard, Happy New Year, Gerard. Does waiting until the end of the year to convert to Roth reduce Medicare income penalty? Now, so what Gerard is talking about is the income related monthly adjustment amount. I believe that is, and clarify if that's not what. So the income related monthly adjustment amount is based on your modified adjusted gross income. So your modified adjusted gross income is going to be determined, on your tax return. And then Medicare has a 2-year look back on that. So you're not going to be assessed your Medicare surcharge, the IRMA amount, for 2021 until 2023. So that's why we start a little later when we're increasing income. We increase income for our clients when we're doing Roth conversion. It's no doubt about that, right? We take it up and we increase that income. But when we're done our Roth conversions, and we had several people graduate last year, no more Roth conversions. That's exciting. But they'll have a 2-year overhang of continued IRMA charges. And you've got to be aware of those, and you got to do that as part of the calculation. It's not just about the tax. It's also about all these other, it's not just about the marginal tax rate and the amount that you're sending to your state and federal governments if you pay state tax on Roth conversions. But it's also these phantom types of taxes, and that is like things like IRMA. Good question, Gerard. Okay, so let's move into our planning portion. Okay, so you should see my whiteboard in front of you, and it should say financial planning topic, inflation. Can the Fed increase rates? Just raise your hand for me if you can see that. Thank you, everybody. All right, so you know the drill. I'm going to move this. I'm going to be looking down so I can write on this thing. Okay, so here's where we are. So I explained to you what the Federal Reserve we're talking about. We're talking about the Fed, right? So that is the Federal Reserve. So their job really is to manage growth, as I said, manage growth, employment, and inflation. So the concern right now is inflation, 6.8% year over year inflation. That's consumer price index. That's a national average. I don't know if I've seen the local number yet, but this is unsustainable, right? 6.8%. The target rate, I believe, is 2.5 to 3, but someone will check me on that. But what we calculate right now, well, what we did calculate was 2.43. So that's something that has to change for your planning. So if we just take that up to 3.5 or 4% inflation, that's going to affect a lot of financial plans. So this is a real problem. So the Fed can't allow that to continue. So the strongest tool that they have is increasing interest rates. So the current Fed rate is 0.25%. Currently, and these are going to, so this is the Fed rate. This is a very simple view. Look at this. Now, we've got some financial scholars on this webinar, and there are nuances, of course, but I'm giving you an overview, an easy to understand overview. So you've got the Fed rate at 0.25. You have the 10-year Treasury at 1.7%. So that's where it stands currently as of the end of the week last week. So if the Fed increases a quarter of a point 3 times for 2022, Well, you'll see we end up at 1%. If the and the idea is, of course, and of course, if it's 4, it's 1.25, and nobody knows what it's going to be, right? So the Fed has said they plan on 3. Some people are thinking it's going to be more. I think Jamie Dimon said more than 4. So, and I believe the Fed said 3. And somebody can check me on that if you'd like, but I believe the Fed said 3. Maybe they've revised that since the end of the year, but that doesn't necessarily mean the 10-year Treasury is driven by the Fed rates for sure, but also the market. So if this matches, and now at the end of the year, 2.7% is what the 10-year Treasury is, then from an interest rate point of view, that's working. And what happens is that that could dampen demand and give the chance to catch up, right? Because there's supply chain issues, you can't get things, and that's driving up inflation. That's one of the things that drive inflation. It's also employment, but that could give an opportunity for things to slow down a little bit. And now things cost a little bit more because, if you're basing mortgages on 2.7, now you go from sub 3% mortgage to a 4 or 5% mortgage. It just and everything else is affected, of course. So fundamentally, and just basically that could work. Here's the problem, though. We have this thing called our national debt. Well, that's terrible. Let's change that. Our national debt. Now, I'm not going to drag this down, but I went this morning to usdebtclock.org, and anybody can go onto this, and that is just something that shows our debt. And right now, as I'm looking at that, it is 29,709 billion. You can't keep up with these numbers, right? They move so fast. I'm just picking one as I see it, right? So $29 trillion, 29 trillion dollars. Well, I don't know why it's so sloppy. Because it's my first webinar of the year. Well, we have to pay. Here's the correlation of these things, these interest rates we talked about up here, also affects this, because we have to pay interest on this debt, right? We owe this money to other nations, to each other, to ourselves. We buy our own debt, the government does. So what happens when we raise interest rates? Now there it is. At current levels, 1.7%, the cost of this is about $276 billion, right? So that's the interest on that. If at 1.7, if the U.S. Treasury goes up to 2.1, then that becomes $290 billion. And that's what we have to pay just in interest every year. That's not paying down the debt. That's just the interest on the debt. And we are required constitutionally to pay interest on the debt. We can't not pay it. If it goes to 2.4, the 10-year Treasury, what did we say? If it just followed the Fed and had to go to 2.7, if it goes to, so here is 2.1. This is at 1.7. Let's put the numbers in here. 2.1. And over at 2.4, let's just go up a little bit. We're at 305 billion. I'm just going to abbreviate that. And then if we get to 207 or 2.7%, these are percents, we're at $332 billion a year. So you see the problem here. With every Fed funds increase, there's a risk that we now have to pay more interest on the debt. Well, not a risk. We're going to have to pay more interest on the debt. So what does that mean? That means that more money comes out of the Treasury that we pay our taxes into to pay the debt. So that's kind of the cycle. As interest rates go up, now we have to pay more on that debt. That makes sense. People are going to pay more on debt. That's why it's designed to dampen things, but we can't dampen this. We must pay this. So the concern many folks have, including myself, is that, well, wait a minute, Fed, how aggressive can you really get? Because they're all talking about the hawkish Fed and we're going to raise rates, and that's going to correct this inflation. Well, what if we get stuck at this second increase because the markets continue to go down, interest rates are going up, which is causing, because again, it's not a direct correlation. The 0.25% of the Fed increase doesn't mean 0.25% of the U.S. Treasury. It could be more, it could be less. What if suddenly we can't afford, it's getting really bad, and the numbers are we already can't afford this debt. We can't afford it now. It's just going to get worse as the numbers increase. And remember what the average should be of that debt, the interest rates, 5.5%. So we have a really, really long road to get here. And at 5.5%, well, geez, let's just double that number. We're at about $610 billion a year. So if we go back to the average inflation rates, or excuse me, interest rates, what is that going to mean for inflation of our debt service? And where does that money come from, right? If the Fed is successful and they're able to balance that down, take that 6.8% current CPI and bring it back down to 3%, right? Let's just say they raise rates 4 times, they're able to dampen that down, bring it down. But then they also raise, to the average, right? This is the average they want to get to. What if we return to this average? Well, the money has to come from somewhere, right? We have to pay this debt. There is no saying that we can't pay it. Where's that money going to come from, folks? Well, most likely it's going to come from your tax, right? So we've got a couple different issues there. So we're going to see increased tax. We all know we're going to see increased tax. Nobody argues this anymore. But the other problem is we just may not have the tool we need for the Federal Reserve in the long term, and the long term being by the end of the year. And that's a concern that I have. And that's why I believe, and I told you, that we're probably going to see, this is my opinion, either a very soft market, sideways, small growth, or zero return, or negative market, because I think what we've done is we've removed one of the important tools from the Federal Reserve. Just by the fact that we've added so much debt. Now, remember, these numbers here that I'm showing you, 290 billion, that's based on $29 trillion in current debt. Now, that's under the current legislation that's been talked about, and this is likely to increase over the next several years significantly. So, and every president has done it. Every president, every administration has increased this national debt, but we could see a lot of volatility in the markets while this is being tried to be figured out, because this is unsustainable, right? 6.8% we can't do, folks. This we can't do. I don't know what the balance is. I don't know where the balance is in between here, but we have to work it out. We're going to be forced to work it out together. And what that forcing of working out together means is that the S&P 500 starts here, right? So here's 1/1/2022, and it ends over here 12/31/2022, just by date. Well, what's going to happen in the meantime while we're all working it out? Well, there's going to be a lot of volatility, and in my opinion, we're going to end up somewhere, down or sideways, very close. Now, could we be working it out and end up here? Yeah. Hallelujah. And we'll be positioned to have some appreciation here. But this is my concern for 2022, and for all the reasons I just talked about. So that's the concern I have about why the Fed may not be able to raise those interest rates like they're talking about. It's not just me. There's a lot of folks talking about it. So that's my thoughts on that. Any questions that anyone has? Okay, good. Well, we are solidly at quarter of. If this is your first time joining us on these webinars, we typically end right around quarter of to the hour, right? Sometimes we go to 11 o'clock depending on the topic. And if there's a lot of questions, there's not really a lot of questions today. I think we only had one. I hope that was helpful. We went over the slot report, a lot of good information about the RMDs. We give you some updates on the markets, gave you some feelings about analysts out there. I like you to hear what people are talking about. And then we go over a financial planning topic every webinar. This one was really centered around investments and how do we position ourselves from an investment point of view and what could potentially happen. And you know my thoughts based on the Federal Reserve and what they can do. So I hope that was helpful. I hope to see you next Tuesday. If you need anything from us, feel free to reach out, send us an email, give us a call. We've got David McKnight next Wednesday. You'll be receiving an invitation for that, and that's going to be a lot of fun. Don't miss that one. 6:30 p.m. We'll have a big crowd, but we can hold up to 500 now, so that's good. And we'll see you soon. Have a great week. Take care.